Good morning and welcome to the Killik and Co market update. Broadly speaking, markets are still below the highs they hit at the end of 2021, but despite that, a number of stocks have still hit record highs this week. And a couple of examples are consumer staples retailer Costco and healthcare insurance company UnitedHealth Group. Healthcare and consumer staples are considered to be defensive sectors, and this generally means that investors are happy to invest in those sectors in times of market volatility because they tend to be relatively stable. And we've put this chart together to illustrate this. So on here we've got the S&P 500 index and the growth constituents of the S&P 500 index shown by the pink and the purple lines, and then we've got the share prices of Costco and UnitedHealth Group. All of these are shown over a 5-year period. So let's take a look at the S&P 500 index to start with. You can see if we look at the growth constituents of this index that those constituents outperformed when the market was doing well in 2021, as you would expect. But as we moved into 2022 and the market fell, the growth constituents were much more badly affected. Then let's take a look at the two individual companies, Costco and UnitedHealth Group. Here we're looking at the last quarter in particular, and you can see that these two share prices have really moved ahead as the rest of the market has come down. So this really just makes the point that it's really important to have a diversified portfolio. You're never going to have a portfolio of stocks that will all outperform in all market conditions, but if you have a good mix of different types of stocks, you should hopefully always have some stocks that will outperform no matter what the market is doing. The IPCC, or the Intergovernmental Panel on Climate Change, has published its latest report into climate change. The IPCC is a body of the United Nations, and it was set up to assess the human impact on climate change. There's a real sense of urgency in this latest report, and the IPCC has really made it clear that we need to be investing more quickly into new sources of renewable power. There's a sense that the global commitment to invest more in renewable power has been delayed, firstly because of COVID, and now because of the situation with Ukraine. And perhaps further to that, the fact that the oil price has gone up so much because of the situation with Ukraine has actually encouraged oil companies to go back to exploring for oil and to produce more oil. Here's a chart that we've taken from the report that shows where our emissions are coming from and how that's changed over the last few years. And you can see that in 2019, 64% of our carbon emissions came from fossil fuels. So there really is a clear need to reduce our emissions from this particular source. There were some really interesting comments in the report, and we'll take you through a few of those now. So firstly, the report said that between 2010 and 2019, average annual global greenhouse gas emissions were at their highest levels in human history, but the rate of growth has slowed, so that's certainly a positive. The report also said that without immediate and deep emissions reductions across all sectors, limiting global warming to 1.5 degrees Celsius will be beyond reach. So that's where that sense of urgency is coming in. And then the report said that since 2010, there have been sustained decreases of up to 85% in the costs of solar and wind energy and batteries. So that is a clear positive. And then finally, the report said that an increasing range of policies and laws have enhanced energy efficiency, reduced rates of deforestation, and accelerated deployment of renewable energy. We are at a crossroads. The decisions we make now can secure a livable future. So the clear point this report is making is that we need to start investing much more quickly in renewable power. So do give us a call if you'd like to talk in more detail about the companies that Killik & Co is investing in at the moment. And finally, there's been concern here recently about interest rates going up, but this week we had a good lesson from Turkey in what happens to inflation when interest rates are too low. This week, inflation in Turkey rose above 60%. Here on this chart, you can see that Turkey started to suffer from rising inflation in 2018, and the normal response to this would have been to raise interest rates to get this inflation under control. However, the Turkish president ordered for interest rates to be lowered in order to promote economic growth. After that, lockdown happened, and that did manage to lower inflation. But more recently, we've had the combination of lockdown ending and people going out to spend again, interest rates being too low, and energy prices going up, and Turkey being a big importer of energy. And that has led to a horrendous rate of inflation in Turkey, and the situation there is obviously a real concern. Moving on to have a look at next week. It's a 4-day week because of the Easter break, but we have got results out from UnitedHealth Group and the big banks Goldman Sachs and JP Morgan. That's it from us. Enjoy the weekend, and we'll see you next week.